nothing I can do.
Hi, everyone. So, Lisa here. I just wanted to take this opportunity to share with you another person that I work very closely with. And we're going to do this series as, just like the others, basically, where I'm going to ask the questions. And the reason that this came about, to be quite honest, is because I have questions all the time from my clients and potential clients. And by the time they get to me, they're afraid and they don't feel like their questions are being addressed, or they don't feel like they know the right questions to ask. So, in order to kind of deal with that, I decided that, hey, we're going to do this series where I'm not the expert, they are, but I know what I know. But this is an opportunity for me to ask some questions on your behalf, and they're going to answer them right here. And so I'm going to have this gentleman introduce himself, and he's just going to give me his name, and then we're going to start with the questions. Got it?
All
All
right.
right. So, hello.
Hi.
Introduce yourself
Hi,
to everyone.
everyone. My name is Malcolm Crane, producer, branch manager with Fairway Independent Mortgage in Towson, Maryland.
Okay. All right. So, the first question that I have for you is, oh my goodness, I don't know what to do with it. What is, tell us a little bit about your background and how you got into the mortgage industry.
Okay. So I've been in the mortgage business for 16 years now. I'm recognized as a top 1% mortgage originator in the country. Honestly, I stumbled in this business. I wasn't I did not know what I was getting into. Let's just say, I started right out of college. I had a background in sales, and I was like, you know what, maybe let me try my luck at this. But it's definitely taken a life of itself. I love helping people. I love making a difference and helping people achieve the American dream, and it's definitely become a passion of mine. And I just love helping people.
Okay. All right. So you use the term originator. Sorry, a little bit closer now. You use the term originator, and we tend to do that in this industry. So kind of explain to the people what that is, because I
Sure.
don't know what that.
So pretty much a mortgage originator is the same as a mortgage loan officer. The only difference with me being a branch manager is that I run my own office as well. So I do have other loan officers who are also under me, but I'm essentially a mortgage loan officer. My goal and my job is to give financing to clients who are looking to purchase residential properties, and I would give them different financing options as a result.
Okay. All right. The next question. What do you enjoy most about your job?
You know what? What I like most about my job is that every day is something different.
Mhm.
Every day looks very, very different. But ultimately, I just love helping people. It feels really good when you can help a family get across the closing to the closing table. That's something that just it never gets old, in my opinion.
Okay. Why is that? Why does that never get old?
Never gets old because every I always say every family has a story, and
Mm,
sometimes I've been able to help families purchase a home for they might be the first generation to be able to purchase a house. I've
mm.
had other homeowners who they could be very young and they're on the path to creating wealth for themselves and their family. So now they have a leg up compared to maybe other people. I've helped an 80-year-old buyer purchase a house where that I was able to see that, she was able to see that it's never too late to be able to go after your dreams. So to me, like it's just that it never gets old, helping people of all walks of life is something that I really enjoy doing.
Okay. So, what are some of the current trends in the mortgage market that buyers should be aware of?
Ooh, I like this question. So, what I would say what buyers need to be aware of is I always say clients need to be able to compare offers from lenders apples to apples. So, what exactly do I mean by that? Some lenders make a practice of quoting interest rates significantly lower than other lenders. And let's just be honest, most lenders have similar interest rates. So, if one lender is significantly lower, there could be a reason for it. One of the major reasons is that that lender is charging additional closing costs, or as we like to call it, points. when that lender is charging that client extra points, 1 point is 1% of the loan. So if let's say it was a $300,000 loan, that client may not understand that the reason why they are getting a lower interest rate is that lender may be charging two additional points, which would be for a $300,000 loan would be an additional $6,000. So as a result, that client is actually paying for that lower interest rate. So I always tell my clients when you're comparing lenders, you want to compare apples to apples. You want to make sure that we have everything in place so that you can make an educated decision that's best for you and your family.
So let's kind of talk about that point thing for a second because you said that's closing costs. Is that normally closing costs that we'll see points? And how does that's one question. So keep that in the back of your mind. The second question would be how would a buyer, a potential buyer, know what to look for as far as these points are concerned?
So in terms of points, it's not normal closing calls. It's supposed to be optional. And that's the thing in terms of working with me. I'm going to give my clients both options. But unfortunately, some lenders don't give them the option. Some lenders just say, hey, this is my rate, and it comes with points. Typically, what I'll do is I'll tell the client, hey, look, if you pay 1 point, let's say it's a $300,000 loan, it's $3,000, you may save an extra $150 a month. That means your recoupment period might be a year. Does this make sense to you? I let that client make that decision so that they can understand whether or not that makes sense to them or not. But it's not supposed to be automatic. Let's just say no, it's supposed to be optional.
Okay. All right. Next question. How do you see the market evolving in the next year?
Well, you know what? Good news for buyers is the fact that interest rates are starting to decrease.
Hmm.
When interest rates start to decrease, that's obviously a good thing for everybody's buying power, and where they want their monthly payments to be at. Bad news is though that I think that it's going to create more of a demand for homes, and then we may get back to more of a, multiple offer situation. So I do think that if buyers on the fence about whether they should purchase or not, this is the time to do something because there's going to be more and more people as they hear that rates are improving are going to re-enter the marketplace, and then there's going to be more competition as a result.
Okay. All right. Thank you. Next question. Can you walk us through the typical mortgage application process?
Sure. So typically with a mortgage application, we're going to ask a client for a couple of different important information. Obviously, we're going to want their full name, their legal name. I say that because you'll be surprised some people actually don't put their legal name. We want their date of birth, their social, their address for the last 2 years. We're going to want their employment information for the last 2 years as well. We're going to also want their assets, but specifically the assets that they're going to use for closing. So they don't have to put every single asset that they own, but specifically what assets they would be using specifically for closing. As
Can you
well, there's
explain
also
that for us? Can you explain that for those of us that may not know what that means?
sure. So, for example, let's say a client needs $20,000 that they need to close to bring to the table, but that client has two different accounts. They have one account that has $30,000 in it, and another account that has $70,000 in it. That $30,000 account is sufficient because it covers their $20,000 needed for closing. We don't need that $70,000 account. Some clients like to show us how much money they have, and I'm not mad at them for that, but all they would be doing is giving themselves more work to do. We only need the last 2 months of bank statements for the account that they specifically will be using.
Okay. All right. So, what are some of the common challenges that applicants face? That's the first part of the question. And how can they overcome them? So, please, if you can make sure that you answer both.
The most common I would say challenge that we have is credit right now. Obviously some people have a past, and that's perfectly fine. What my team and I do is we strive to work with clients who do have credit challenges, and we have a team in place and other third party companies that we work with that can help eliminate or improve some of their stuff, that the derogatory items that's on their credit, such as late payments or collections. We work with different companies that can assist clients in terms of getting those removed. but at an affordable price and at a quickly as well, because it's very important to work with third party companies that are not just trying to take your money as well and take forever to do these services. So we've vetted, a lot of different companies, and I would say that I'm comfortable with some of the companies that we work with, where we're able to, get people the best of the best who can give our clients the same customer service that we're gonna give them.
Okay. And so if they were trying to do this on their own, what would be some of the challenges that they could, how could they overcome them?
So on your own, the easiest thing I always tell clients, a good website is called myfico.com.
Mhm.
It'll show you how a credit score is comprised. The biggest mistake I think most people make with credit is the amount of utilization they're using, meaning the amount of credit that's being used on revolving accounts, specifically credit cards. So I'll
Mhm.
give you an example. Let's say a credit card is $1,000.
Mhm.
Typically, a lot of people think that the credit bureau does not want you, as long as you pay your stuff on time, it's sufficient. But it's not that. That's not the case anymore. You paying your stuff on time is very important, obviously, but the amount of credit you use is equally important. So what a lot of people think is that you can only use more than 30% of the limit. What a lot of people don't know is that the credit bureaus have changed their algorithms recently, where it's 10% of the limit. So meaning if that credit card is $1,000, they do not want that client to use more than $100 on that credit card. So if they leave more than $100 on that credit card after the next billing cycle, their credit score could be compromised as a result as well. So, and that's 30% of your credit score. So I tell people all the time, first start with that first. Obviously, you making your payments is equally important. But if you're not making your payments, that's unfortunately not something I can really do other than encourage somebody, please do not be 30 days late on your credit. As well, too, new credit is also important. Sometimes some people just need more credit on their credit report. They just don't have enough history on their credit report. So sometimes, being added as an authorized user or adding a department store card can also help as well.
Okay. So my next question is, what advice would you give to a first-time home buyer or to someone first-time buying, someone buying the home for the first time?
Two things. One, you have to know what you want. Okay. You have to know what you want. You have to know, and when I say know what you want, you have to know first off where you want your mortgage payment to be at. You have to set realistic expectations. I
Okay.
have so many clients that they say, Malcolm, I want a $2,000 payment, but they're looking at a $500,000 loan. That's not realistic. So,
Mhm.
first they have to understand where they're comfortable with where they want their budget to be at in terms of where they want their monthly payment to be. The second thing is they
Okay.
also need to understand how much funds are they willing to invest in the purchase as well. Those two things is going to help the lender determine what purchase price they should go for or they could potentially get qualified for and how much funds they're going to need for settlement. I think those are the two main things, just in addition to just continue to try to save up as much money as humanly possible.
So let me ask you this. This is an aside, a kind of as a result of what you just said. When you say save as much as possible, what does that really mean for buyers?
That means that you're gonna really have to clamp down and, going it's gonna take a little bit of sacrifice. So sometimes some people are used to a certain lifestyle
Mhm.
before they purchase the house, but it may mean you not going out as much, maybe
Mhm.
mean you not doing DoorDash as much, but actually make setting a goal and sticking to that goal. So like if your lender says, hey, look, I'm gonna need you to save five or $10,000.
Mhm.
Let's stick to that. But if your behavior is gonna be the same, then you're not gonna hit that goal. So sometimes it means us changing our behavior so that we can obtain that goal.
Okay. The next question is, what are some common mistakes that you see that first-time home buyers make?
Well, so
And
you know what?
then I want you to. I'm sorry, I didn't mean to interrupt, Malcolm. And
Mhm.
then I want you to tell me people that are not first-time home buyers what the mistakes they make.
So this is what I will tell you. This is where I say the best team always wins. You need a good real estate agent, but you need a good lender. If you have a good lender, then my job is to minimize those mistakes. Okay. But I will say the
Okay.
biggest mistake I see most people do is getting new debt because a lender is going to look at a debt to income ratio. So if you know you're trying to purchase a house,
Mhm.
purchasing a new vehicle with a new car payment is not going to help. Opening up a new credit card or open up a credit card for furniture is not going to help. So the biggest mistake I see that people make is that they acquire new debt and then that takes away some of their buying power of what they could qualify for
So when you say they acquire new debt, when are they acquiring it?
before closing. So typically like it
Or
could be
close?
at the pre-approval stage where,
Okay.
they so I always say this, if you're looking to do something, just ask your lender. So
Okay.
meaning, I have clients that, I had a client the other day. They said, "Hey, look, my car just broke down. I need to buy a new car." But guess what? That client, they make enough money where even if they buy a new car, their debt to income ratio can cover a new car payment. I
Okay.
asked them exactly, what do you think your car what's the max you're gonna pay for a car payment? They told me, I double checked, even with the new car payment, the deal
Mhm.
still works fine. So
Okay.
I always say over communicate. Just remember that your lender, including your agent, is in your corner. Our
Mhm.
job is to try to get you to the closing table. But if you don't communicate and you don't tell us, we don't know.
Okay. Fair enough. All right.
My saying
Um,
actually is always be proactive instead of reactive.
would, would you give that same advice? Remember, I was asking about the some of the mistakes that first time home buyers. What about people that are buying like their second home or maybe some other type of property?
So you know what? Now, for people that are buying their secondary home, or like
Mhm.
let's say for the second time around, I think it goes back to having realistic expectations in terms of where they want their mortgage payment to be at.
Okay.
The reason why I say that is because we're coming off, years of very, very low interest rates. I was
Mhm.
just talking to a client today where they're paying $2,000 and their loan was 400,000.
Mhm.
They want to buy, they want to actually downsize, but I was explaining to them that for $2,000, that would be a $300,000 purchase price and
Right.
not four. So I'm like, you're gonna have to either feel comfortable with actually paying a little more, maybe for less,
Yeah.
or you're gonna have to use some of those proceeds that you made from the sale of your house and put it towards a down payment to maybe make, align everything in your favor.
Okay. Great. The next question: how important is a credit score in the mortgage approval process?
Credit is very, very important. Credit is going to determine which loan program the lender puts the client in, and it's going to also determine what type of interest rate they're going to get. Credit, credit, and assets are probably two of the most important things in terms of purchasing a house.
Okay, when you say assets, again, remember these are people that they haven't purchased, they haven't done this. So when you
Money
say
saved up.
asset, what money saved up? Got it.
Yep.
Is it only money saved up when you talk about assets?
So that's a good question. Assets could also be a retirement account too. So there's many people that they don't save up a lot of liquid cash, but they always make sure they max out on their retirement and their 401k and they have access to that. A lot, I'd say about 40 or 50% of my clients actually take money out of their retirement account too. So that's why when we say assets, not good, it doesn't have to be just one thing. It could be a CD, it could be a retirement account. It could be a checking or a savings account. It also could be maybe potentially family too. Like if your parents guaranteed you that they're going to give you gift funds, then that's something that you just want to make sure that they're ready to go once you find your house as well.
Okay, true that, true that. Okay, so what steps can a potential buyer take to improve their credit scores?
First thing is, I think that they need to talk with a lender and find out where their scores are at, because
Mhm.
the one of the biggest mistakes I think people make is they depend on some of these apps that are not accurate, like the Credit Karmas of the world. And those Credit Karmas of the world are not bad, but they have a whole different scoring system than what mortgage lenders do. So I think that first thing first is that client needs to apply and get a consultation with a lender like myself so that this way they can understand where they at. My
Mhm.
company does have the ability to do soft credit pulls as well too. So if people are worried whether they or not, their credit is going to get dinged or messed up, we can do a soft credit pull. But I think first they need to evaluate where they stand, and then they need to depend on a professional to tell them what they need to do.
So when you talk about that's the first time that you mentioned that term, a soft credit pull. Can you explain to the viewers what you're talking about?
Sure. So we actually have, regular a regular pull is considered a hard credit pull. So that's when a lender is pulling somebody's credit, you're gonna get a ding where it's gonna be on your credit report that a lender pulled your credit report.
Okay.
However, we have the technology now where we can do a soft credit pull, which means that it's going to be the same scores, typically just like a regular hard credit pull. We're going to see all your debt. We're going to see everything just like a regular credit pull, except it will not show up on your credit report. So you will not have to worry about, am I going to lose any points by this lender pulling my credit or anything like that. We're able to do that, and then still just like a regular pre-approval.
Okay. All right. You haven't said much about that, but we'll talk about that in a second. All right. So the next question is, what different type of mortgage products are available?
There's a lot of different mortgage products available. I mean, typically you have your vanilla stuff. You have your FHA, you have your conventional loan, you have your VA loan, you also have USDA, and then
Mhm.
you have different programs that can go, with those type of loan programs.
Okay. So let me ask you this. So when you said, so you were talking about are there anything besides those types of programs that buyers normally kind of get into or not really?
Not
Because
really. I mean, I will say
yeah.
for people that are looking for creative stuff, we do
Mhm.
have bank statement loans if you're self-employed and you're not claiming any income. We also
Okay.
have 1099 loans where you might be writing off stuff on your taxes, but we have something like that as well. So we have some creative type of loans, but for the most part, I'd say 80-90% of most clients are going to do a FHA or conventional loan.
Okay. All right. So how should a buyer choose the right mortgage product for their needs?
Good question. So I think that's where, as a mortgage loan officer, that's pretty much my job. I say I'm the matchmaker. So as the matchmaker, first I'm going to always explain to the clients what does the FHA loan mean, what does a conventional loan mean, what are
Mm.
the qualifications of this, and then so that's typically what we do on the initial call, even before my client applies.
Mhm.
Then once they apply, then my second call with them is pretty much saying, hey, look, you know, based off of maybe your score, based off of your debt to income ratio, based off of your assets, this is what I think is the best loan program for you. So,
Mhm.
as the matchmaker, I would pretty much make that assumption. And then, obviously the client can disagree, and I'm obviously gonna do what the client thinks is best, but I'm always gonna give reasons why I think either loan program is the best for them.
Well, at that initial or at the second one, I'm not sure which one you indicated. You spoke about the fact that you're going to advise them as to what type of loan product they should have. Are they given options or are they just given one thing?
Yeah, so typically, like I'll give an example. Let's say somebody is with an FHA loan. Typically, with FHA, you don't necessarily have to have the best credit in the world. You just have to show a likelihood that you pay your stuff on time. So with
Okay,
FHA, the minimum is 580.
right.
Then you have conventional. Conventional is going to be more credit driven. So meaning the better credit you have, the better rate in terms we can offer you.
Okay.
Conventional on paper, the minimum is 620. However, because it is credit driven, typically you want to have a 680 to 700 credit score for
Okay.
conventional to make sense for you. So let's say if a client is at a 620 credit score, automatically I know conventional is probably not going to be the best bet for them because that interest rate on conventional is going to be significantly higher compared to FHA. So I'm going to say, hey, look, based off your credit score of 620, FHA is going to be the best bet for you.
Okay. Got it. All right. Thank you. All right. So, what's the most important things a buyer should consider before applying for a mortgage?
I think the most things that buyers should consider is really just kind of figuring out where they want their mortgage payment to be at, not looking at purchase prices. Because I always have clients that say, I want to buy a $400,000 house. Okay, where you want your mortgage payment to be at? I want it to be 1,500. That's not realistic. 1,500 is going to be under 200,000. So I think people first need to understand, where do you want your mortgage payment to be at, and are you flexible with that?
Mhm.
Then based off of that, then that is going to help your mortgage lender determine what you qualify for and what type of purchase price you should be looking at.
Okay, okay. And so again, I guess my question to that is, I'm trying to understand. So then if they have an idea in their mind, because most people when they come to us, okay, so like I'm the first stop and you're the second, right?
Mhm.
So when they come to us, they often say, well, this is what I want to pay, but this is what I pay in rent. And so as long as I pay this in rent, that's fine if I don't go over what I pay in rent. How do you square that when you're talking to clients?
So from experience, and that's a good question. So from experience, then that's where I'd say, okay, based off of this number, you would be looking at a purchase price of around X.
Right.
But then I'll say, are you comfortable with that? And then
Mhm.
some people, and this is the type of conversations I'm gonna have with my clients on initial call, because we got to be honest, we got to figure out where we need to be at. And then some clients might say, all right, 300, that's it. Yeah. And then they say, all right, can we go up to 350? We can, but just know that it's not going to be around where you said you wanted your budget to be at. Is that okay? They say yes, and then we'll go into 350. So that's the thing, is like, I'm just going to make sure that everybody, we're very clear. We try to over communicate where they understand that, hey, I'm going to ask you where you want your payment to be at. I'm going to give you an idea of what that would take. But on the flip side, I'm also, we can obviously be flexible too, based off of how flexible you want to be.
Okay, got it. Are there any final tips for our viewers?
Um, I would say, first off, it is never too early to apply and to get
Mm.
started. I have clients that say, Malcolm, I'm not buying for another year. I'll hit you up in 9 months. It's never too early to figure out where you're at, because again, you want to have professionals in your corner who's going to give you a game plan up front. I always say it's better to be proactive instead of reactive. So I rather have that peace of mind, which I think is priceless, to know that everything is in place so that when I want to buy next year, everything is already in place for me. So that's the first thing. Second thing is, and when in doubt, always continue to save up. If
Okay.
you're not sure, just continue to save up. Change your budget. Try to figure out what you can eliminate from your budget, because when you purchase a house, that's a completely different responsibility. So I think, or even when you're purchasing the next level house, meaning, after that second house, which is probably going to be more expensive, really
Mhm.
focus on your budget and figure out what you can eliminate so that you feel comfortable. My team and I, what we want to do is not only get people in homes, but we want them to be comfortable in their home so that they can ultimately build wealth for themselves and their family.
Okay. So that's good advice. So one of the things that I want to say is really appreciate you taking the time to do this, because I think it's important. I think that people being educated is very important. People having options is also very important to me and the way that I run my business. And so I just want to, thank you. And I'll make sure that, we get the word out about, the process, and that over communicating, what did you say, is better than under communicating?
Always better be proactive instead of reactive.
Always. Well, I'm gonna have to borrow that. Well, I thank you very much for that, and I appreciate your time. Thank you so
Sure.
much.
All
All
right. Take
right.
care.
All right. Take care.